In this video, I'm going to share with you how to read the Camarillo levels, apply the pivot points to your chart using a script in MQL5, and understanding the impact of Bollinger Bands on multiple time frames. Let's dive in. What I do is I grab my cam levels script each day, and basically that plots the levels according to the high, low, close of the previous official cash chart day, and I manually type those numbers in. It plots all of these levels. Starting from the outside, the purple level, we've got R3 and S3. So the S's are on the bottom side, the R's are on the top side for support underneath and resistance to push the market back down. Moving down, we have R2, the breakout long, and then accordingly the breakout short. R1, the high, so the previous day's high. The close of yesterday, so where the market officially closed. We've got the pivot point, breakout short as mentioned. We've got then the S1, the previous day's low, and the S2. These levels offer an insight into where the market might target, the range for the day, and where the market might see some support and resistance come in to turn the market back around. Often we're looking for trades that play out inside these levels and inside the range. As we can see yesterday, we had some rejection off this area, and then finally coming right down to the S3, we've started to see the market find consolidation before pushing back up. And notice how it came back up to the close as a central level. So that was the close of the previous day to this day, whereas this is the close of this day here, so this level here. So the market has closed again in the same area. And basically what we look for each day is depending on where the market is about to open. So right now we're sitting on the close, and that means that basically the market could really go either way. For example, if the market was trading down here at the breakout short at the time of the open, we may look to target the close. So basically bringing the market back inside itself rather than expanding outwards. However, if we did break these levels here, the market could push down further to perhaps the S2 or even the S3, and sometimes even the low. So what we then use in determining where we might turn around is previous trading price points. So we're looking for areas where the market is pushing price back up, often on a larger time frame, but particularly on the previous day. So for example, if we saw the market start to reject around this level at the S1, it could be confirmation enough to get us in. And then obviously the low is as low as yesterday got, and then there's a big gap between the low and the S2. It's about making a decision based on what the price and the bars are doing when the market connects with these levels, and using the footprint to determine when the market might actually turn around. But on the face of it, we're really looking for these levels to hold, particularly when they're close together. So these two levels are kind of close together, and that means they may have a chance of bouncing. We did have a bounce yesterday off the level for about 50 points, which is great. However, it did turn back around after running into the S1, and that provided some resistance to push the market back down before we came back up to hit that close price. So there's about 160 points in that move, which is really quite a good move on the DAX. If you're trading the FTSE, for example, through Apex Trader Funding, you'd be looking for the FDAX contract. The close forms a common target. However, if we open, so when I say open, as in the candles are trading, so the current price is outside of these levels here. So for example, the market pushes right up before the market open, and we open and the market price is up around these levels, our new target could be the high. So it forms a stronger target. It's called an extreme gap, and there is a chance that we'll come down to meet the previous day's high to fill that gap, or even further down to the close. So if we push all the way up in the pre-market, we open here and we see some rejection, we may look to target the high. And same goes for if we were opening, so price of the market before the open is down here, we may look to target the previous day's low. So the gaps, these two red lines and the close, can form targets for us. We can also see rejection off each of these levels. So it's really about forming an opinion, and some days are far easier to trade than others. So sometimes it is better to sit and wait for a better opportunity. Now, looking at the Bollinger Band setups, we can see that the Bollinger Band here is at the close. If we were to spike up, there could be a chance that we'll come down. So spiking outside of the Bollinger Bands can present an opportunity to push the market the other way. As we can see on the 5 minute, we can see that lines up with the pivot point. So we're looking for points where the Bollinger Band on certain time frames matches up with a level. So we're going to now jump over to some higher time frames to see what we might actually be expecting on a larger scale. Based on this, we might look to reject off the pivot to then buy, or off the close to then short if we did push outside this level here. However, there are other factors such as previous price points. The market looks to be reasonably happy trading above this close point for a little bit of time, so it may hold. So there's other things to consider other than the Bollinger Bands and the technicals, but you get a feel for the market as you look into it each day and you're actively trading it. So let's go on to some higher time frames just to get a feel for the market. We've had 3 down months, and basically the monthly gives you an overall picture of the flow of the market. You know, is it moving upwards? Is it moving downwards? As we can see, it's moving down quite heavily, and we've actually touched the middle Bollinger Band here on the monthly. We've pushed through the moving average 20, and we've broken below the moving average 8. So the monthly chart is a good way to kind of get a feel for where the market has been heading and where it sits in the scale of history. We move down into the weekly chart. Now, the weekly again is still quite large in terms of seeing the price points. So it's a matter of determining if you know the price of the cam levels and you're outside of the weekly Bollinger when it touches one of those levels on the 5 minute, for example. So let's say 14,466. We'll go back to the weekly. 14,470, say. If we did touch the S3, we may be looking outside of the weekly Bollinger Band. And as you can see, the market often does reject off the Bollinger Bands. So if we did get down to the lower level, the S3, 14,464, I'll just double check that figure, 14,464, we may look to get long on the basis of the level, the S3, as well as this Bollinger Band, which often has a strong representation in the market and a strong reaction. However, it's not always the case, so it's always good to be careful, as I always mention. Now we'll jump down to the daily. Because we're zoomed in enough now, we can see the levels. And if we come down to hit the previous day's low, the red level, we can tell that the Bollinger Band is in line with that level. So if we were to come down and touch that level and the Bollinger Band hasn't spread out further and we poke our head outside of this level to the downside, we may look to buy on that basis. So while it's all very subjective and it does take practice, It's about using different information such as this level here, the low and the Bollinger Band, or if we did get lower, the S3 and the weekly Bollinger Band, it's about using that information to make a decision at the time. So trading is quite a challenge in that regard. Now we've got the 4-hour Bollinger Band. So there's nothing really to the upside for these Bollinger Bands today. It's all to the downside in terms of being able to reach one of these levels and in conjunction use the Bollinger Bands as an indicator to get us long or short. So to the short side, this Bollinger Band is very in between the levels. But if we were to break this level and come right down and touch the S2, and that Bollinger Band hasn't spread out further, it may be an indication that we'll look to buy. Whereas if we get all the way up here, we've already passed all the levels. So it would be very hard to make a decision on where to actually get short on the basis of the pivot points. So again, it's about combining the different levels as well as other indicators such as the Bollinger Bands and the standard deviation, along with price history. So we can see here there's a very strong wick off the low. So that could serve as an indication for the low to be a very good buying point. Just in today's example, because we'll get very close to the Bollinger Band on the daily if we did get down that low. And then we've got the strong wick here on the 4-hour chart as well, showing that there were buyers coming in and sellers weren't willing to hold this price point. We go down to the 1 hour. That could be a nice buy off the low based on the 1 hour, because we would hopefully poke outside of the lower Bollinger Band into the low and then turn around. However, we do finally have some interaction to the upside where the Bollinger Band is lower than some of these points. So if we were to spike up and perhaps hit the R1 or break out long and quickly start to reject, it could be a valid short position. Down to the M30 or the 30 minutes. So we're just looking at each Bollinger Band and see if there is a significant price point interaction where the market squeezed in and we're able to spike outside into another level and then turn back around. We'll check the 15-minute. So very similar on the smaller time frames. So based on the Bollinger Bands on the daily, for example, and the 4-hour, and the 1 hour, not the 4-hour, it could represent some good buying opportunity because there'll be multiple traders looking at the 1 hour time frame and also the daily, potentially using that Bollinger Band as an indicator, as well as the previous day's low and this pricing interaction here. And the 4-hour, we had the wicks bouncing off that low. So in terms of reading these pivot points, it's very much about seeing what the market does as well. So we may wish to get down here and then buy it. However, if the market doesn't get down there, we have to look for other opportunities or sit out of the market for the day until a clearer opportunity presents itself. So each of these levels may have potential to turn the market around. However, we're looking for additional information, such as these levels being close together, to potentially take us into the market. Then additionally, I do like to use the Bollinger Bands on multiple time frames, such as the daily today if we were to get down to the low. However, we don't always reach certain Bollinger Bands and the market may be quite slow. So that's really all there is to it, and getting a feel for what interacts and what doesn't is all about practice, because some days, for example, this high point might hold, maybe because there's pricing in the history, Whereas normally we would look to get to the breakout long or the R1 before we actually look to get short, but the market could turn around at the high. So we're looking for other information such as the footprint, the volume footprint for those looking at the Apex Trader Funding, Tradeovate data, or pricing history. Where has the market been happily trading? Where has it been turning around or finding pricing resistance? And then using the Camarillo levels as an additive to determine the range, the targets, and potentially the turning points for that day. So it's really about practice, looking at the levels each day, and I can take you back through a few examples here as well, just to see what we've had. For example, the breakout short had a lot of rejection here, and the close, not too much motion on that particular day. This day here, we finally reached the S1 and breakout short. That was after some time. So this is an hourly chart, and we dropped right down through the close and into the pivot at the open, and then we kind of drifted down and finally had a potential buying opportunity to bring us back inside itself and go long off these levels here, and then potentially short again off the R1. So using these levels and obviously the Bollinger Bands and price action to determine whether we want to get long or short. This day here, we did bounce off the S1. That was at the open. That was a very good trading day. We got all the way to the pivot. A good target though is maybe just the close. This day here, we went short and we broke out the whole day. Had a reasonable rejection off the S3. I'll just check that. For about 70 points before breaking down below the S3. So obviously if you didn't get out, you would have taken a lot of heat on that trade and probably had a losing position. So this day we came up, we hit the R2 and then turned back around and basically have been dropping ever since. This day here we've opened at the pivot, pushed right up to the close and beyond into the R1 before then turning back around and pushing higher. This day here was a very strong buying day, so a lot of motion long. A lot of traders might have been looking to get short on the R3, however it just pushed straight through and there was a lot of buying on the 10th of October there. So the levels, as you can see, don't always get respected. They were kind of finding their feet here. We dropped before the market opened, possibly getting a lot of sellers into the market before it opened, and then it just powered on up. So always be aware that the market doesn't always respect the levels. On this day, on the 9th of October, came down, hit the S1 and had some good buying activity there a couple of times, so a couple of opportunities. Even just looking at the 1 hour chart, very scrappy day here, not an ideal trading day. However, you can see the Bollinger Bands were almost touched at the lows before the market turned around, so potentially traders might have got in here at the R2 to look to turn around. Again, we're touching the Bollinger Bands at the R2 and then down on the low. However, this is a bit of a scrappy trading day. It would have been tough to read. This day here, we kind of used the highs to keep us under wraps under this price. Rejected off the pivot, but it was very sort of a consolidated day. This day here would have been an excellent trading day. So S2, we came down, so we opened on this candle here, came right down through the Bollinger Bands on a 1 hour into the S2, and then got long for about 180 points as the target if you were using the pivot as the target. Some people might have gone all the way to the breakout long, but it didn't get up there. So you would have really had to have watched the market. Also, a good target would have been the previous day's low or the close. So again, holding that position longer is really up to the trader. So you can see a bit of a theme here. The market pushes in a direction It tries to look for support or resistance at these levels, and combining that with the Bollinger Bands, particularly on different time frames, can be very helpful. If you know what you're looking for before you go into the market, and that's why I do the pre-market analysis. So here you can see the market pushed right up into these levels, the R1 and the breakout long, and then it came right down to hit that close and beyond. It came right down to the S3 actually. So very strong selling day, that one. The market had a lot of build up here. People may have been looking to short on the R2. However, it did push up higher. So some days it just doesn't work. But if you did hold that position, it did get very close to the close gap. So depending on how you want to look at the market and how big your stop losses are and that kind of thing, it will vary from trader to trader. I would have been stopped out on this trade if I had have gone short. However, as there's a lot of building in the market, it may have been a better option to just go long and perhaps get out at some point, but that's not really how I like to trade, and it's not something that I've really tested. So I prefer these positions here where the market comes right down, touches the breakout short, for example, and then comes right back up towards that close gap. So that's not a bad trading day if you kind of waited for that to be hit, the breakout short, and then got long, or even if you waited a little bit longer for that Bollinger Band to spike out and get close to the S2 before getting long. If you held that for basically the rest of the day, it's almost 200 points, which is an excellent trading day there. So hopefully that's enough examples to give you a bit of a feel for what we're looking for and the type of analysis that I do, but then using that to make an assessment each day and decide whether it's worthwhile waiting for the market to open and place a trade, or perhaps sitting out and waiting for a better opportunity. For example, when the breakout short, the S1 and the low are all very tight together, sometimes that can represent a very good opportunity to hold the market up. So the market might come down sharply at the open. So you're using that increased volatility and volume to then take you back into the market to get long off a very tight set of levels. You might have a couple of Bollinger Bands that are in line with that level, and perhaps some wicks that have rejected off that same level in the past as well. You might even go back and look at the daily and say, right, we've had a lot of rejection here, and if there was another wick, another couple of wicks, it could represent some really good opportunity. So it's also not so much about reading the market as it is being patient and waiting for the right setups, waiting for the right prices to be hit, and then reading what the market is thinking about doing next when you see a bit of build up and then it starts to drop off. So that all comes with practice, but the gist of it is basically using the levels in conjunction with pricing history and Bollinger Bands on multiple time frames, plus using that open volatility. So when the market opens, using that extra volatility to push the market out of whack and then take you back into a central price point such as the previous day's close. What I mean by that is if the market sharply moves at the open to the S1, and let's say there's some Bollinger Bands on higher time frames that are spiked outside of very sharply, we might look to the footprint to identify some buying coming into the market, and then hopefully we would be targeting the close gap over the next sort of 5 to 30 minutes. So that sharp move at the open, if there's a lot of volume coming in, it pushes it right in one direction. You see it rejecting back off these levels and the Bollinger Bands across different time frames, plus the pricing history. You could be onto a good setup. When you're looking to trade in between these levels, it becomes very challenging to make higher quality decisions. So being patient can be very helpful in this market. That's it from me. I hope this was helpful. I hope it helped build your understanding, and I'll be back soon. Remember to like and subscribe, your support means a lot to me. Can't wait to see you in the next video.